Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Thank you for joining us. It's Robert Kuhn, host of Destination Retirement, president, founder of Kuhn Capital Partners. We're fiduciary, we're independent, we're a registered investment advisory firm. Hopefully everybody has listened to the show before. If this is your first time, welcome. If you have listened to the show in the past, thank you and welcome back. A couple things I want to talk about initially. The word fiduciary, it's important, especially in this market. I think it's critical. Unfortunately, that word is thrown around way too much. So make sure you are working with a fiduciary, not only a fiduciary that can manage money, but a fiduciary that can also bring strategies to the table that can help you preserve principal or even make money when the markets are down, especially given what's going on today. That is certainly something that piques an interest to a lot of listeners because we get calls each week going and want, for those investors that want to learn more about it. So I think a good litmus test of if you should reach out to us is very simple. If you cannot point to a bucket or an allocation or a sleeve of your portfolio that is protected against market losses or can deliver positive returns if the markets are down, then I think you would benefit from having a conversation with us. So if you'd like to have that conversation, it's very simple. Just give Paige a call. You can give Paige a call at 630-492-1912, 630-492-1912, and she will set some time up for us to have a conversation this week. So a lot going on. Obviously, this week we were up, we were down, we were up, we were down. I think when you listen to what is going on in the market, or when you watch what's going on in the market, I think it has a lot of people very, very concerned. Some things I want to talk about today in particular really are going to be based around managing risk, the bond market, taxes, tax reduction, and just go over a handful of strategies that we often talk about on the radio. For those that want to learn more about the dual directional banknotes, again, when we talk about specific strategies, it's very important for you to understand that they may or may not be appropriate for you. It's not an investment recommendation. I think it's really just pure education. My job as an advisor is to bring to you strategies that you simply don't know existed in many instances. So just because I talk about a specific investment, that doesn't mean that it's right for you, doesn't mean that there's not risks, that there's not rewards, there's concerns, things we need to talk about. So I just wanted to make sure that I am sharing that each and every show, because sometimes I forget. But I think it is my job to talk a lot about just different types of strategies. So the dual directional banknotes, as you know, hopefully if you've listened to the show, you get a cap on the upside. They are 15 months in duration. Generally, those are the ones that we utilize. We find those to be the most attractive, given we're going into an election year, given inflation is high, given growth is slowing, interest rates are high. There's many people that are very concerned that we're going to be in a stagflation environment for a period of time. And if you have a strategy, if you work with an advisor that, simply employs what we call a closet index fund strategy, which is you own stocks, you own bonds, and you simply track the market up and down. And for that right, you pay a fee. I think you're going to be very disappointed over the next handful of years. And so the dual directional banknotes add a level of protection. They're offered by the big banks, JP Morgan, Citigroup, Bank of America, et cetera. There's a cap on the upside. The last one we did was capped at 22% on the upside. So if you're content with a maximum gain over a 15-month period of 22%, then obviously that one at the time would have been a good investment. They do vary depending upon when we issue them or when they're issued. So it could be 18%, could be 20, could be 22, could be 24, but you get some sort of a significant cap. We consider it significant on the upside. On the downside, from 0 to negative 15, you actually receive the inverse rate of return. So if the market is down 7, you're positive 7. If it's down 15, you're positive 15. So obviously you can see why that's very compelling to many people. And then if the markets are down more than 15%, the first 0 to 15 you don't experience. So look at negative 15 as your 0. So if it's down 16, you're down 1, 17, 2, 18, 3, 19, 4, et cetera. So if you want to learn more about those or at least get on the distribution list of when we do them, we usually do them every couple of weeks. If you do them and we commit to aggregating our clients' assets, and if we're going to do it over $1 million per note, you're going to get a much better maximum gain. So just give Paige a call if you want to get on that list or you want to learn more about it. 630-492-1912, 630-492-1912. So a lot of people are nervous. A lot of people are concerned, and I think rightfully so. When you have the likes of people with the stature, the historical performance, just the kind of the clout on Wall Street is Stanley Druckenmiller, which, you know, that name to the average investor probably is not known, but you can do some research on him and his performance, and you know it's probably hard to match. But when he was last week, he was at the Robin Hood conference, and he had a really interesting quote. And we've been through 2 or 3 months of a pretty devastating period, and what he said was, "All I know is every sale I made." He's happy about, and every buy he made, he's not thrilled about. And that, should, catch people's eyes. But I'm afraid it doesn't, because when you're managing money, when you're driving around or you have a portfolio and you're driving around on a Saturday morning, what I have to understand is a lot of times you're relying upon the advice, the management of an investment advisor. And unfortunately, when we look at the investment advisory space, I think it's broken because their goal generally is not to manage money or manage individual risk for individual clients. It is to raise money because they're getting a fee. So the more money they raise, the better or more income that they are going to make, that the firm is going to make. And certainly not every advisory firm is like that, but most are. At least that's my history, my experience in 26 years in the business. But when you have the likes of Stanley Druckenmiller coming out and saying those things, you have to wonder, what exactly is going on in the market. And I don't think Wall Street has done many things, or advisory firms have done many things good, but they certainly are very, very good at trying to convince investors that it's simply time in the market. Don't worry about it. Feel okay with losing money because you don't need these assets for 10, 15, 20 years, 30 years, et cetera. And that is not a good way to think, especially in this market, especially with the headwinds that we're facing. And so if you're with an advisory firm that is simply index based or just trying to outperform a broader benchmark, I think you're going to be disappointed. And so I think you need to learn what we're doing, because when you look at I think, you need to look at, do you have time to recover from the next market decline? Because it's going to happen. It's not if, it's when. And if you have a 10, 15, 20, 30-year time horizon, you're going to see 30, 40, 50% corrections. And the challenge is you don't know when those are going to happen. And if you have a portfolio that's not structured correctly in the beginning, then you're going to be disappointed. And I think my job as an advisor and the founder and president of an advisory firm is to bring education to the table, which we do each and every week. Because if you lose 30% of a portfolio, which on average is every 9 years, so it's going to happen. I mean, what most people don't recognize is you need 43% just to break even. So if you lose 30%, the following year you have to, or the subsequent years, it's going to take you 43% just to get back to even. And that is challenging because, most people don't have that time. And so advisors, Wall Street that are, advising other people and managing other people's money, they're very good at convincing you that it's okay to lose 30%, or you can't play defense and you can't incorporate strategies that can mitigate the downside. That's just not accurate. It's not accurate in any way. And I want to make sure that we continue to get the message out that there are strategies that can buffer the downside, or even strategies that your floor is 0%. So the worst year you're going to have is 0%. So all of your principal is protected, and you still have opportunity for what I would consider above average growth and tax deferral and the potential for guaranteed lifetime income. And there's just a myriad of different types of strategies that, if you're concerned about the market, if you can't point to a bucket of your money that is protected, then we need to have the conversation. Because when we look at what is going on in the market today, not more and more, it's just most advisors are still utilizing fixed income as a means of portfolio diversification. And we're in the worst 3-year period in the fixed income market. So I want you to stop and think, if you're driving around on a Saturday morning, what does that mean to you? Well, just think of last year. So markets were down 20%, plus or minus. Your fixed income bucket, which your advisor had led you to believe should be the portfolio stabilizer, should be the buffer in a down period. Well, that was probably down 10 to 30%. So think about that, 10 to 30%. So not only did you lose money in the equity space, which is going to happen, but your safe money, the money that your advisor told you was there to diversify risk, was there to mitigate drawdowns, was there to provide a buffer when the equity markets were down. Well, that was down 10 to 30% most likely as well. So what gives? And if you look at, what most individuals are utilizing as a means of diversification, you're in a 3-year bear market, worst in history. So we love the equity markets. We think there's tremendous amounts of money in the equity markets, money to be made in the equity markets. I just think we need to look at the safe money side differently. And we're going to talk a lot about kind of the KCP dynamic strategy that we are incorporating, which is very, very unique. And we'll dive into that, on this show. But I was driving into the office this week and I started to think, right as I was literally pulling into the office, I was thinking, equities are great. You can make a significant amount of money in the equity market, but what keeps people from not investing more or staying invested when times are bad? And I think it's twofold. First and foremost, it's they don't have anything safe in their portfolio. They don't have anything in their portfolio that can do well if the markets are down. They don't have anything in their portfolio that can at least, your floor is 0. So whether the markets are down 10% or 50% or 100%, you're going to make, nothing. And we have to look at or reimagine or redefine what you're using for your safe money. And I'm convinced that if you knew 10%, 30%, 40% of your portfolio, whatever that number is, that you knew your worst return was going to be 0, and it was a true portfolio stabilizer, what I think that would allow you to do is stay invested during periods of market weakness. And so we have to really rethink what investors are utilizing for their safe money, because bonds, I think, have proven to be a challenge. Bonds are easy. They're easy to understand. And unfortunately, advisors don't want to go the extra mile and explain that there are other strategies out there that actually, I think, deliver better risk reward characteristics than the bond space. And so then that would allow investors to stay invested in the equity markets more so than they are today. And then second of all, I think if you worked with an advisory firm and we're going to talk about the dynamic portfolio here today, but if you worked with an advisory firm that wasn't simply just trying to hug an index or have a closet index fund type strategy, and what I mean by that is you basically own a bunch of different investments, but they simply move in tandem with the market. So the advisor's great when the markets are up. They lose money when the markets are down. And then investors are on this, simple roller coaster. So if you lost 30%, which is going to happen every 9 years historically, it's going to take you 43% just to get back to even. So in this market, we need to talk. If we can help you, if we can educate, if we can answer any questions, if you want to bounce what you're doing off of us, simply give us a call, 630-492-1912, 630-492-1912, or visit the website, kuhncp.com, kuhncp.com. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Back, you're listening to Destination Retirement. My name is Robert Kuhn. I'm president, founder of Kuhn Capital Partners, host of this radio show. I want to thank everybody first and foremost for listening. We do see the podcast numbers because we do podcast every episode. So they are going up and to the right. I think that's my job. I think I'm doing my job. If I see podcast numbers go up, that means I'm educating, I'm helping, and that is at the heart of everything we do. So we are a fiduciary. We are independent. And we do incorporate strategies that can do well when the markets don't do well. Unfortunately, most investment advisors do not, and most individual investors don't understand that. Guess what? You can make money if you have the right strategy in place when the markets go down. So don't just buy and hold. I think buy and hold is going to disappoint. Yes, you need to do it at times, but there is another bucket to managing money, and that is defense. So I think a good litmus test of whether you should reach out or not is think back to last year. The stocks and bonds were down simultaneously. Would your portfolio have benefited from strategies that could have delivered positive returns in last year's negative market, or protected your principal when the markets were down? So if so, let's have a conversation. Let's go over the pros, the cons of all of these risk managed strategies out there. We do work with investors that have $100,000 to invest, as well as investors that have net worths of $20, $30, $40, $50 million. So if you have a willingness to learn, and if you have a willingness to let us help you and manage risk in a way that you may not fully understand initially, then we're going to be a good partner, and we're going to be a long-term partner. And that's something that we look at when we're looking at who we want to help. So give Paige a call this week, 630-492-1912, 630-492-1912. Set some time up and we can have that conversation. So we often talk about the 60-40 portfolio. If you look back in history and in that performance, it certainly has done well, but interest rate environments were significantly different throughout that period of time, if you go back to the mid-'80s, than they are today. And unfortunately, as much as we like to say that individuals are rear view mirror investors, there you go, say that 3 times fast, meaning they want to invest in what did well. That really doesn't mean anything as far as what it's going to do in the future, but it's easy for an individual to quantify and make decisions on what did well because they're not in the industry. They don't live and breathe this 24/7, 365, as much as my wife and my family get annoyed at us doing that. Most individuals are making decisions on what did well yesterday, not what could do well tomorrow. I think investment advisors are equally as bad because they just simply have strategies in place that'll do well when the markets go up. And you know what? There's 2 other types of markets, down and sideways. We've always had, or at least believed, that the up markets take care of themselves, and how you outperform the markets over time is losing less, or at least or losing less, number 1, or even making money when the markets are down, number 2. If we can incorporate that, then I think we're going to increase your return possibilities, certainly over a period of time. And most people don't fully understand what 0.5% of outperformance or 1% of outperformance or 2% of outperformance, just the impact that could have over a portfolio period of 5, 10, 15, 20 years. It's significant. So I encourage you, especially in this market, to really learn, how you can lose less or even make money when the markets are down. So, if you look at the last 7 years, U.S. stocks have annualized almost 9%, 8.8 to be exact. And fixed income, which, we're using U.S. bonds in the 10-year, it's the aggregate of all bonds. They're actually over the last 7 years negative. So think about that. So equities are positive, just under 9%. Bonds, which are really supposed to be your portfolio stabilizer, are negative. So what that gives, a 60-40 portfolio, 60% equities, 40% bonds, that gives a 7-year performance of 5%. I mean, is that good enough for you? I mean, you really need to stop and think. Is that going to help you meet your goals, meet your objectives when we're in a high inflationary period, when we are in a high interest rate period? 5.4% is what the average, what the 60-40 portfolio has done. And that's assuming you could, have handled, COVID and not made any changes in what happened during that period of time when the world is supposedly ending. So if the 60-40 portfolio has done 5.4% and then you're paying an advisor 1 to 2%, what really did you make? And it's so frustrating on my end to see that most advisors are only managing risk with bonds. Yet, we were in a period of, I think, a very telegraphed period of, of time where interest rates are going to go up. And okay, let's give, most people the benefit of the doubt. Maybe the interest rates rose faster than many people expected, but we knew they were going up. I mean, the Fed did everything they could do in 2001 to telegraph that, interest rates are going to be, were going to go up and what that was going to do to the bond market. So I promise you, the investment advisor adjusted for his own personal money, and the firm certainly adjusted for their own money. Wall Street, the banks, they absolutely invested for, the firm's money. But what about your money? And, generally individual investors, are last to have changes be made. And we're here to change that. We're here to bring a fresh approach to managing money. We're here to bring you, the individual investor, institutional like strategies that can really do well or make money in down markets. U.S. bonds are down 16% as of November 1st, 16% over the last 3 years. It's the largest 3-year decline in history. And that's using the Bloomberg U.S. Aggregate Bond Index. If you look at longer duration bond strategies, which many advisors were utilizing because they were stretching and reaching for yield, I mean, those could be down 20 to 30 to 40%. I mean, don't believe me, just go Google your favorite long bond fund, long bond ETF, and look at that performance. So we're here to change it. We're here to give a fresh look. We're here to reimagine, rethink how we manage risk. So 630-492-1912, 630-492-1912. Give Paige a call. Let's set up some time to talk. Let's set some time up to have a complimentary portfolio review. Let's stress test your portfolio. Let's look and see if you have any risk management inside your portfolio. Because here's the deal. Over the next 3 years, 50% of the $34 trillion of national debt matures. During those years, budget deficits will add at least another $10 trillion. And if the government pays 5.5% interest on that $27 trillion, I mean, that is going to be significant. And that's why we're starting to see a lot of, at least the bond guys, the old adage on Wall Street, whether it's right or not, whether I believe it or not, the bond guys are the smart guys, the equity guys are the dumb guys. Maybe it's somewhere in between. I don't know. But you have a lot of very influential bond heads that are out there saying that interest rates are going to get cut 1 to 2% next year. Well, that may sound really great. And I think it certainly is good for the liability or the liability side of your balance sheet. but there's a reason why those interest rates are going to be cut. And many people believe it's because the economy is going to not do well. We're going to be in a recession, or even worse, we're going to be in a prolonged down market. And to stimulate growth, I mean, it's this vicious cycle, right? Of interest rates and what they did and how fast they rose, they increased, and what that did to inflation, and then slow down the economy. And then here we are now having to cut interest rates next year. So it's something that, you really need to consider, and you really need to factor in the national debt. And it's something that we don't talk an awful lot about, but we are currently witnessing the greatest treasury bear market in history, and that's going back to 25 years. So for those advisors that are still utilizing what I consider dated ways to manage risk, I'm not saying that all bonds are bad. I'm not saying that you shouldn't have allocation to those strategies. Please don't hear that. But unfortunately, most advisors that are advising on, clients who have $100,000 to really $10 million of investable assets, they're only utilizing fixed income as a means of kind of an airbag, as a means of a seatbelt. And unfortunately, that's hurt investors, and it's probably going to continue to hurt investors. And those are things that, we want to make sure that, we are fixing and really fixing before the problem or the accident. So 630-492-1912, 630-492-1912. If we can help you in any way, if you have any investment related questions, please make sure that you give Paige a call, reach out to her. She can set some time up for us to have a conversation. Seems like we're pretty heavy on statistics this week and on this week's show. And I've seen just a bunch of great ones. And anytime I see a good statistic that I think would benefit you to kind of either A, prompt you to reach out to us, or look at your portfolio in a different light, or question your advisor, I'm going to share those with you. I'm going to continue to share those with you because that's our job. But if you look at the S&P 500 since December of last year, we've seen three corrections. And December 13th to the 22nd, we saw a decline of 8.2% and then a rally of 11.4%. February 2nd to March 13th of this year, we saw a decline of 9.2% and then a rally of 21%. July 27th to October 3rd of this year, we saw a decline of 8.5%, and then who knows where, the rally will ultimately stop. So history certainly doesn't repeat itself often, but many times it does rhyme. And so if we're in that type of a period, and we hear a lot of people saying, we're going up and we're going down, we're going up and we're going down, but we're not really getting much further ahead, there's a reason why. And the portfolio management is truly what is failing you. If you want to learn more about what we're doing, any investment related questions, 401k, tax reduction, which we're going to talk about here after the break, just give Paige a call this week, set some time up for us to have a conversation, 630-492-1912, 630-492-1912. More after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise. It's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners. We're independent. We're an investment advisory firm. We're fiduciaries based in Chicago, but we do have offices spread out across the United States. We do work with investors across the United States. This radio show does air in multiple markets. So if you can hear my voice, then rest assured we can work with you. Our job is to construct a portfolio that is structured to provide better outcomes. Our clients demand a better investment experience. We believe we're leading the next big leap in portfolio personalization and incorporating strategies that can do well and make money even if the markets are down. So if you'd like to learn more about that, we can certainly help you, because our belief is you can be both a bull and a bear simultaneously if you have the appropriate strategies inside of your portfolio. So if you'd like to learn more about what we're doing, or if you have any investment related questions, certainly please give us a call. You could reach out to Paige. Paige will set some time up for us to have a conversation. It's very simple. That conversation is very educational. It's very really more of just a get to know you session, for us to learn about your specific situation, what fears you may have, concerns you may have, learn more about what you're doing currently, what you like, what you don't like. And then we can certainly share with you what it is that we do, why we do it, why we think we're different, why we think we're in the top 1% of investment advisors that are bringing you strategies that most other advisors don't. And then if you find more interest, or if you find what we're doing appealing, and if you think that we can help you, then we can certainly, take it to the next step. So give her a call. Her is Paige. Paige is our great assistant, 630-492-1912, 630-492-1912. I think it's important for you to understand, especially just driving. I try to put myself in your shoes. Driving around, I hear more and more, I've listened to you for a month, 6 months, a year, 2 years, whatever it may be. And now you're just finally calling in, and thank you. And I think that's fantastic. I would like people to call in sooner, and that is not necessarily only a self-serving, statement, because if you call in sooner, you may lose less if ultimately the markets go down. So if you have any interest whatsoever, I think it's important for you to certainly reach out to us, and we can share with you what it is that we're doing, because I do think Wall Street is broke. I think Wall Street convinces individual investors to invest differently than what advisors are doing with their own money and what firms are doing with their money. So people utilize us generally in two fashions. We certainly have the advisors or the clients rather, that move over all of their money to us, and that is fantastic. A lot of people will think it's putting all of your eggs in one basket. And if we had one or two strategies, I guess that would be a fair statement. But the reality is we don't. We're more just the quarterbacks, and we're farming out, strategies that, we believe can do well, whether the markets are up, down, or sideways. So we have probably the majority of people who come to us, we're managing 100% or near 100% of their investable assets. But there are many people as well that we're a satellite manager, and they're not ready to commit to 100% change of what they're currently doing. And that's perfectly fine. Again, this is what's best for you. It's not what's best for our firm. And so a lot of times, investors will come to us and say, we want you to manage 25%, 50%, something less than 100 in specific targeted strategies that we are managing. And so we have no problems with that at all. So whether it's 100% or 25%, whether you use us for everything or we're a satellite manager, we certainly are open to seeing if we can help you. And if we can help you and you want help, which is most important, then we're going to certainly, I think, have a long, profitable partnership for you. And it's going to be a great partnership for us as well long term. So 630-492-1912, 630-492-1912. And here's the deal. Again, we've talked a lot this week about how traditional investment advisors are failing clients. Just look at your portfolio last year. Did your equities lose money? Probably you could check that box. Did your safe money, your bond money, the strategies that were there to be the stabilizer, were there to be a diversifier, were there to make money when the equities were down? High likelihood that you also lost money there as well. And if that is the case, we just need to talk. If you look at ultra long duration treasury bonds, so many people, when you hear treasury bonds, they're backed by the full faith and credit of the United States, right? So I would consider that money good no matter what. If we disagree, we disagree. But treasury bonds, in my opinion, are money good. But people don't understand that you can still lose money in treasury bonds. And ultra long duration treasury bonds have now lost more on a percentage basis than stocks did during the great financial crisis. So think about that. From peak to trough, extended duration treasuries are now down 58.3%. that exceeds the peak to trough losses in the S&P 500 during the stock market crash of 2007 to 2009, which was down 56%. That's an issue. And, people will say, they'll come back and say, well, I'm not losing money if I don't sell those bonds. And that's 100%. Well, I think a near 100% if you believe, the Treasury is always going to make good on their financial obligations, the government rather. I think that's a very accurate and very fair statement to say. However, tell me how you feel looking at your statement being down 58.5% with your safe money. That can't make you feel good. And more importantly, if you're down that much, you have locked up, fixed income investments at historically low interest rates. So you must have locked up those investments, paying, 2%, 3%, 4%, not even 4%, 1 to 2 to 3%. And you're missing out today. We have 2-year treasuries that are paying, north of 5%. You have money markets that are completely liquid today that are paying 5.5%. And so I'll go down another rabbit hole. A lot of people will say, well, heck, I can go and just put my money in a money market and make 5.5%. Well, that is very true. But what is that really doing? I mean, are you actually growing your money? What is your real rate of return after inflation and after taxes? So, I was talking with a gentleman who sold his business. We're going back maybe 2 years ago. I think it was in 2000. I probably have talked about this when it happened on the radio show. Sold his business, did very well. Was in a really unique industry. I think if memory serves me correct, he sold his business for $13 to $15 to $16 million, which obviously by any measure is success in my opinion. And he put a large chunk, I can't remember the exact percentage, but it was significant. It was maybe more than half, maybe even 75% of his money in long treasuries. And the treasury at the time was in the neighborhood of 1.5% to 2%. He bought 30-year treasuries. And because he said, listen, I only need $200,000 to live on, and then I'm perfectly fine. We certainly advised against it. He did not end up working with us because I think a lot of it had to do with our thought process on letting him know that we didn't agree with doing that in putting more than half of his money or 3/4 of his money in treasury yield bonds when they were yielding, what they were yielding, because we saw that interest rates were certainly going to go up, and we knew what was going to happen to the value of those bonds. And we were honest with them. And, unfortunately, most advisors would do or say anything to get a $10 to $15 million account. And we just don't look at the world that way, because we think if you're coming to an expert that you need our advice, our honest advice, our fiduciary advice. It's our job to always share with you what we think the outcome is going to be. And he didn't like it. And he was probably used to advisors falling over him and telling him whatever he wanted to hear so they could get that money. And, that was probably an account that I'm very, very happy that we didn't take, because I would ultimately have been responsible, even if I didn't agree with it, for a portfolio that now is probably down on paper 40 to 60%. And not only, are you seeing it down on paper so much, I mean, look at you could go and get those same bonds for 3, 4, 5, 6%, or 100% to 200% more than what he had locked, those bonds up for. So I know a lot of this stuff may not make exact sense to you, because this isn't something that you do every day. And so that's our job. And I think, we're one of the very few fiduciaries, at least from what I can tell, that focuses on protective investing. Protective investing is a portfolio management philosophy that I think thinks well beyond a simple mix of stocks and bonds. And if you can, the trade-off, well, there's two things for you. First off, I guess a downside is we may have multiple meetings. We may have multiple calls. It may take you a little bit longer to fully grasp what we're doing. I don't know if I would consider that a downside for you. It's probably a downside for the advisor, because, they want clients immediately so they can be on to the next one. But, if we can do that, the benefit is a much higher probability, at least in our opinion, of meeting your goals and your objectives, and meeting those goals and objectives in a way that is less stressful. So I think, again, we need to reimagine how we're managing risk. We need to reimagine, given the environment that we're in, we have to play the hand, the cards you're dealt. I think, most people understand that, but when it comes to investing, advisors are still investing as if, we're in a 10 to 15%, growth environment where liquidity is prevalent, interest rates are non-existent. And unfortunately, that's just not the environment we find ourselves in today. So when we get back, I know we said we were going to talk about the dynamic portfolio. We'll certainly talk a little bit more about that. And we're going to talk about some tax strategies and some private investment strategies, where they're right, where they're not right, and should you consider those. So more after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. I'm also the host of this radio show. If this is your first time, welcome. Hopefully you'll at least try to find our podcast and listen to past shows and listen to future shows. Our ask for you is, if you do catch us on the podcast, please send the link on to somebody who you think needs to hear the story. That would be great. We would really be appreciative of that. It's not just a self-serving ask. I mean, we are here to help people. That is something that gets us up every day, and we are different. We are unique. We think we are one of the 1% of investment advisors that are bringing to the table strategies that we would classify as protective investing. Protective investing is a portfolio management philosophy that thinks beyond a simple mix of stocks and bonds to minimize risk and then ultimately maximize return. Just because we talk about protective a lot doesn't mean we don't want to grow the heck out of everybody's money, because our belief is if we lose less when the markets are down, that is how you're going to outperform the markets. And we often talk a lot about, especially on this radio show, that you can make money if the market's down if you have the right strategy. So rather, like most advisors, always looking at the market in two ways. Most advisors are always going to be bullish, thinking no matter what happens, it's the time to invest. No matter what happens, the market's the best place to be invested. And then the other advisor is always looking at things bearish, as always wanting to just simply provide protection, very little growth, but make sure that you can't lose money. So our philosophy has always been you can be both a bull and a bear simultaneously if your portfolio is structured appropriately. So that's something that we are very passionate about, and something we're bringing to the table to all of our clients. At least we feel that, and certainly anybody who wants to learn more about what it is that we do. So to work with us, it's not based upon your assets, whether you have 100,000 or you have a net worth of $50-60 million. Our criteria to work with us is, number one, can we help you? Number two, do you need help? And then number three, are you willing to receive that help? Those three things are something that we look at when we're bringing on a client. So if you say yes to all of those, then we may have a great partnership, and we hopefully can add significant value to what you're currently doing. So give Paige a call, 630-492-1912, 630-492-1912. Set some time up for us to have a conversation this week, next week, or a time that works for you. If you're listening to the show outside of the Chicago market, rest assured that we can work with you. We can help you. If you can hear my voice, we like to say, then you certainly are a candidate for us to possibly partner with. So give Paige a call, 630-492-1912. So a couple things. Saw a great statistic. just another 20% in the Nikkei 225 will be where it was 33 years ago in nominal terms. Think about that. 20% more in the Nikkei 225 will be where it was 33 years ago in nominal terms. So for people who don't think the markets can stay down and stay down a lot longer than you probably are comfortable with, they can. And I haven't used my trusty statistic. It's one of my favorite statistics. It's something that we share, and I want you to really think about. Had you bought Microsoft in 2000, it took you 14 years to get back to even. So if you bought Microsoft in 2000, you were not made whole or got back to even for 14 years. There's a lot of, at least in our opinion, a lot of similarities to the situation then in 2000 as we are in today. I don't necessarily think we'll see a dot-com crash or another financial crisis, at least in the form that we saw in the past. But I do think that we could be in a significantly high inflationary period, a significantly high interest rate period, a significantly low liquidity period. So I think there's a very good chance that if you are investing as the traditional advisor wants, leads you to believe that you should invest, which is simply stocks and bonds, you may be disappointed over the next 3 to 5 to 7 to 10 years. And for those investors who are 5 to 10 years from retirement, that could greatly affect your retirement assets. If you're in retirement today, it can greatly affect your situation as well, especially in the inflationary period that I think, ultimately we're going to be in. So as we often talk about, our job is to look at, portfolio construction in 3 ways. Growth, first protection, growth, opportunistic growth. And when we look at growth, our KCP dynamic strategy is unique. It's different. It is a very high level, what we like to think as an institutional way to manage risk and to look at the market. It's a component of an overall portfolio of what it is that we bring to the table. We like to look at themes. I think, when you look at the higher, the individuals, generally, if you're not managing, if all of your wealth or the bulk of your wealth isn't in your fund, I don't put a whole lot of stock in what people come on TV and say, because very few people are going to tell you what they truly feel unless they're managing their own money, because they have a boss that they have to ultimately report back to. And if they came on and said the world's going to come to an end, we're going to see, low growth, we're going to see historical low growth, historical volatility, especially with all the geopolitical risks that we're facing today. Chances are that would not be a good conversation that they would have to have with their employer. So when I look at the people that I follow, that the people that I give the most weight to, it's generally people that in the hedge fund space that the bulk of their net worth is tied up in the funds that they are managing. Like you probably heard me say on the radio, a recession is when your neighbor loses his job. A depression is when you lose your job. So the way, again, another thing I haven't talked about a lot here recently, but you have a lot of people that'll say, don't get emotional about losses. Generally, that's people who are managing other people's money. Believe me, advisors look at the world differently in a lot of instances than and how they manage money versus the advice that they provide for their investor, their clients to manage their money. So long way of saying the KCP dynamic strategy is a theme-based approach in a lot of instances, looking for catalysts that are there to ultimately see limited downside, but yet significant growth. A couple things to look at. You look at energy, for example. I think most people can look at energy as a way to, especially in the oil and gas space, that this isn't political in any way, but we need more drilling. We need more oil right now. It just is what it is. And, chances are when we're at a deficit, it's generally a good time to get, into an investment. And then inevitably, When we need to bring more supply online, you see those stock prices that are in the energy space go up. Very simplistic, right? Another very simplistic way to look at a theme is uranium. And I think one of the only things that Republicans and Democrats can agree upon is nuclear energy. Again, not a way to talk politically in any way. We have a nuclear engineer who's a client, and they just are so busy. And I think you're starting to see nuclear energy throughout the world become more popular. And when you look at uranium and you look at the stocks that are tied to that, inevitably, if that is the case, you're going to see those stocks go up greatly. And if it's not the case, you're going to see those stocks not necessarily go down as much, because it doesn't attract a lot of hot money like the Magnificent Seven or FANG or any of the other acronyms that you can want to use. So those are just two very basic theme-based approaches to managing money. But when you can craft a portfolio of 4, 5, 6, 7 different themes, you have some inherent built-in downside, and then you have some real torque on the upside where they can really move on the upside. So different way of looking at it, very high-level institutional approach than just trying to track the market up and track the market down. So any interest in that and want to learn more about that, let's certainly have a call. 630-492-1912, 630-492-1912. There is a $100,000 minimum for that portfolio, but we can certainly have that conversation. So in the final minutes, a couple minutes I have here, I want to talk about private investments. We're starting to see, again, private investments may be new to you. They're not new to endowments, to institutions, to high net worth. But they are starting to become more accessible. That could be both a good thing and a bad thing. I'm not here to pass judgment whether a private investment is good or bad. We have to look at each investment differently. We have to significantly, obviously, do due diligence on each individual investment. But what you do find in the private investment space, if you have over $1 million of investable assets, you have access to private investments. Again, these investments, at least the ones that we utilize, provide two very unique things. Number one, significant tax benefits. We're not tax advisors. We're not CPAs. We're not licensed to provide tax advice. So we're talking at a high level here. But they can provide, especially in the energy space, you can reduce your taxable income in many instances up to 75% of your initial investment. So if you put in $100,000, you would get a tax benefit of $75,000. So think about that. If you have significant capital gains, if you're a high wage earner, if you sold a business, sold a building, sold some property, and you're looking to defer those taxes, or you just don't want to pay any more taxes than you have to, there are some strategies that can greatly reduce your taxable income. And generally, the investments that we utilize in the private investment space are going to pay or targeted to pay anywhere from low to mid double-digit distributions on an annual basis. And so not only do you get the tax benefits that are significant, but you do get targeted distributions, low to mid double-digit distributions that are not dependent upon the stock and bond market. Again, please hear me. Doesn't mean the investments are good. Doesn't mean the investments are bad. Doesn't mean that there are not risks. But those are things that we have to talk about and certainly discuss in greater detail. But if you're looking to greatly reduce your taxable income, strategies are available to you. If you're working with a big bank, if you're working with a big brokerage firm, you do not have access to those strategies. So as I mentioned earlier in the show today, some people utilize us as a satellite manager. If you're looking for 10, 15, 20, 30% of your portfolio to have a strategy that can create significant tax benefits, targeted distributions, low double digit to mid double digit area, then we really need to have a conversation. You've got 2 months left this year to really impact your tax situation this year. So with that being said, I want to thank everybody for listening this week. If we can help you in any way, please give Paige a call. She can be reached at 630-492-1912, 630-492-1912. More next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at cooncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.